All right, guys. So I'm chatting about one of my favorite topics today, which is all about family trusts and using trusts to save tax. Ton of opportunity, perfect time, particularly with what's going on in investment markets at the moment. A lot of money to be made if you're not smart about the tax around how you make that money. That can come back to bite you down the track. So super pumped to get into this. Just before I do though, just for the lawyers, I was never here. This never happened. But look, guys, in all seriousness, not advice, and I encourage you to seek that out, particularly if you're making big decisions around some of the stuff that we're going to be talking about today. And I also just wanted to give a big shout out to our event partner for today, Sharesight. If you're not already familiar with Sharesight, and I know that a bunch of you guys are because you've come across from their invites out. But Sharesight is a powerful portfolio tracking software that allows you to basically check all of your investments in one place. They've got award-winning performance, dividend tracking, tax reporting, and a whole bunch more. So they're up to some pretty cool stuff. If you're not already familiar, you should check them out. And if you've got any questions about Sharesight, you can hit them up on the email address, which is there, which is just support@sharesight.com. Alrighty, guys. So I know I did just share this already, but just for anyone that's just jumped in, and I'll pop this just one more time into the chat. I've put together a workbook for us to sort of guide you as we go through today. Download that, save it on your computer somewhere. Ideally, if you can do it somewhere where you'll be able to make notes on that, that would be ideal because there's a few little exercises that we're going to go through because I want today to be about ideas, but I also want you guys to walk away with some really clear actions because ideas without action are meaningless, and more information it really isn't the answer here. So jump on into that. Actually, could someone just confirm for me that that link is all working okay and it's actually taking you through to the workbook? Just pop into the chat. That would be super awesome. Perfect. Got a bunch of confirmation. Thank you, team. All right, guys. So I've got a question for you before we crack in. I'd love to know so I can sort of shape as we're going through today. But where are you at on your journey around tax structures? And when I say tax structures, I mean things like trusts or even investment bonds, investment companies. Those sorts of things. I'd love to know, are you brand new to this? You don't have any of these tax structures in place. Are you a complete trust pro and you've been rocking it for years and you're all across all of the rules. Maybe you've got if anyone's got multiple entities in place. Love to know that as well. Got a lot of newbies here. Leanne, Paul, GM, Brendan. Brendan's actually got a trust in place. We've got a few investment bonds representing here as well, which is awesome. Hybrid trusts, awesome. So a few different ones there, but there's a lot of people that are here for the first time. And look, as we go through today, I'm going to make sure we're going to get into some of the basics to make sure that you can understand it, particularly if you're not super familiar with this. We're also going to get into some of the more nuanced things that you should be thinking about as you progress on this journey as well. Now, I've got another question for you, and bear with me on this one because there is a method to my madness, but I just want to sort of quantify a little bit around the opportunity here. So I'd love for you to just pop into the chat what your current tax rate is, what your current personal tax rate is. And if anyone's not familiar, basically, if you're earning $190,000 or more, you're on a 47% tax bracket. If you're on a 135,000 to 139,000, that's a 39% bracket, and then 45 to 135 is a 32% tax bracket. So we've got a bunch of people in the top tax bracket. We've got a bunch in the 39% and 32% as well. Lots of highest, and look, it's a double-edged sword. I think for anyone earning over $45,000 is already paying at least 32% tax. But particularly when you get up into those 39% and 47% tax brackets, then the opportunity gets even bigger. And look, so just to bring this home, I appreciate that this is a bit of a random question to sort of ask straight off the bat, but I'd love to know, like, if you think of future state when you've got to the end of your like wealth building journey, what's your ideal level of income that you would want to be getting from your investments and your wealth to allow you to live what we call your ideal lifestyle? We want to make sure that it's somewhat based in reality, but in a perfect world, when you say, okay, I think this is enough for me, how much income would you like to be generating from your wealth and your investments? I'm just going to give you 30 seconds. Just pop that into the chat. I've got a bunch of stuff in here. Infinite. I like that. I like that. I wish that was a number that we could all achieve, Matthew. But thank you for sharing. Look, there is a question of more, but I suppose what I'm getting at is like, what's the number where it's comfortably enough for you? Because when you get to that point, perhaps if you're happy doing what you're doing and you've got some things in place, then perhaps you want to keep going. But it's like, what is that? What is that actual target? Mike says sufficient to buy into a nursing home and to sustain. That's probably a good one. Look, I think at the end of the day, for me, when I say ideal lifestyle, I mean that you've got enough money to allow you to live the lifestyle that you want without having to stress about money. And so everyone's ideal lifestyle is a little bit different. But yeah, it's just whatever that number is for you. And so, look, pulling this together, I can see that there's a lot around the sort of like $200,000, 100 to 200 to $300,000 a year. So a pretty chunky number to get to, and here's the thing, guys. Like particularly when it comes to trusts and tax entities. The tax entities, and when I say tax entities, and apologies for throwing a bunch of jargon at you, but a tax entity is basically just anything with a tax file number. So, every individual in Australia has their own tax file number, every working individual, and then your super fund has its own tax file number. If you set up a trust, it gets its own tax file number. If you use an investment company, it has its own tax file number. Similarly, with an investment bond, it has its own tax file number. And so, a tax entity is anything with a tax file number. So, when I say tax entities like trusts, they effectively allow you to cap your tax at a maximum rate of 30%. And I'm going to show you exactly how that all works as we go through. But that is the limit. And so if you've got money there that you need to spend, you may need to pay a higher rate of tax. But if you've got money that's building and growing for the future, then you do not need to be paying more than 30% tax on that income. And this is the key reason why most people that have substantial amounts of wealth, they use these sorts of structures. A trust is part of the mix. Using other tax entities is typically part of the mix. And, to put it in perspective, and I probably should have put this on a slide, but if we think about, how much money you need to create your ideal lifestyle level of income, we use something called the 5% rule. The 5% rule basically just says that you can draw an income of 5% from a pool of assets without eating into capital over time. So what that means in human words is that if you've got $1 million in investments, that's going to allow you to deliver you an income of about $50,000 a year every single year for the rest of your life. If you've got $2 million, that's an income of about $100,000 a year every year for the rest of your life. And that's for anyone any engineers that we've got on the line, the reason that it's 5% is because that the long-term return of the share market's about 10%, and then you take off an amount for inflation and a little bit for fees, and that leaves you generally pretty comfortably with a 5% number. Now, it is a rough rule of thumb, so it's not live or die by this, but in my experience, it's worked out to be pretty close to the mark. And so the final piece of the puzzle here, and I just wanted to sort of really set the scene before we jump in here. If you think about what your tax drag actually is, because if you've got $200,000 as your ideal lifestyle level of income that you need, using the 5% rule, that means we're going to need about $4 million in investments in order to give you that 200 grand a year. And so as you're building those investments up, if you already look at your current personal tax rate, and we had a lot of people, between 39 and 47%, the difference between paying 30% tax on your investments as they're growing versus paying 47% is really significant. And on $200,000 a year, say, we're looking at 17%, on $200,000, that's $34,000 every single year in extra tax. Basically, just looking at the numbers that you guys have put in on average, that you're paying if you're just copying personal marginal tax rates and looking to build a $200,000 income for investments. And so, uh, is that making sense, guys? If that's making sense to everyone, can I just get some pop a one into the chat? The Awesome. I'm glad. I probably should. I'll put a slide in for next time. But that's the key job for you as an investor. And I get the tax is important at some level, but in my opinion, it's not like the government does such a good job with spending the money that we should be giving them more than they need. I think that in the wise words of Kerry Packer. So the every dollar of tax that you save is an extra dollar that you can grow your investments faster. And guys, you're in the right place today because we're going to talk about how to cut that tax drag and get on the front foot to keep more of the income that you've got there. So, guys, I'm going to get you guys working in a second. So get your workbooks fired up because I'm going to share with you what I call the ideal lifestyle model, which is one of the most powerful money tools that you can use. And I want you to fill it in as we go through. Now, you'll see on one of the pages, and I do have the QR code there for anyone if they don't already have the link. But there's this weird looking picture, a bit of a Venn diagram with some lines around it. It basically will help you to rank where you're at in the different key areas of money, and also give you some direction on what you should focus on next. What the things that will move the dial the most for you when it comes to your money. And so when people think about their money, they think about a lot of different things. That it might be saving tax with trusts, or it might be buying property, or it might be any number of things. But what we find is that at the deepest level, what people really, really want is that they just want the ability to fund their ideal lifestyle. That you can, you've got a nice roof over your head, you don't have a crippling mortgage on that, and that you've got enough income coming in so that you can pay yourself your ideal lifestyle, live the ideal lifestyle that you want. And so that's what we've found over the years is that that's really about three main things. The first one is what we call a replace your salary plan. So you have to have a plan where you can replace your employment salary with investment income so that you're then in a position where you're working out of choice as opposed to necessity. It's not about retirement, but it's about knowing that you're working because you choose to, not because you have to, because you're reliant on the money. The next one is about maximizing every opportunity. So maximizing every single part of your situation. Because there's so many different areas of your money that where you get the real compounding is where you've got every single area optimized and maximized, and you start making really rapid progress. And then the third piece is around giving you total confidence in what you're doing. You're not stressed about money. You feel like you're on top of things. We're not having to be concerned or lose sleep at night because of how your investments are tracking or what's going on or will you have enough or whatever the case may be. And when you've got those three things, they're basically the catalysts that allow you to fund your ideal lifestyle. And so I'm going to tell you why this matters, and start with why it matters to me. To give you a little bit of background, my investing journey and journey around entities and tax structures. I didn't come from money. In my younger years after finishing school, I worked a whole bunch of pretty average jobs. And I worked with a lot of people that were essentially trapped in the job that they were in because they had to for a paycheck. And so I initially wanted to create sort of the freedom with my investing to have the ability to start a business. And when I then started planning to get married and start a family, I wanted to create the ability to create time for myself. And I've managed to do that through my investing. I learned a lot of lessons along the way. I learned a lot of lessons about investing, a lot of lessons about tax structures as well. But it's allowed me to create that freedom, do a bunch of stuff, create some time freedom as well, and travel something that's important to me, and it's allowed me to do a lot of it. And so what I'd love to know for you guys, just so we can really frame up your thinking around this stuff is, why does this stuff matter to you? Like, what made you show up today? What would it mean for you if you were able to, cut your tax and get ahead faster from your investments? What would it mean if you could replace your salary, your employment income with investment income, and have total confidence in what you're doing as well? I'd love for you to just take 30 seconds and just pop that into the chat. Bunch of freedom, time freedom as well, ability to retire earlier from there. That's a really great one. Travel is coming up a fair bit as well. Take more risk with career decisions, absolutely, from Nina. And we see this a lot with people. If you're looking at changing jobs or changing to a career path that you're able to actually that fulfills you in the way that you want, but often there's a cost that actually comes with this. Get ahead before AI replaces me. That's another good that's a good one. Help kids more. Actually, a bunch around family and stuff as well. And so, look, guys, I get that that's probably a little bit sort of tangential to actually trust and tax savings, but I do think it really sets the scenes for the why behind it, because everyone knows you should cut tax, but if you can't link it into what it actually means for you and what the results are that you're pursuing, then you're probably much less likely to follow through on that in my experience. And guys, I appreciate you sharing what it means to you in there as well. All right, so we're going to get into it. So with this model, we've got the three things that we want to get to: replace your salary plan, maximize every opportunity, and total confidence. How we get there, there's basically three ingredients that create this outcomes. The first is having a smart strategy. So you're making the most of the money that you've got, that you're using all of the rules to your advantage, and that it's right for you. And the second is having solid systems around, how you're planning with your money, how you're managing your money, automating your savings, your investing, your debt reduction, whatever those things are. And when you combine together the solid systems and the smart strategy, that's what gives you your replace your salary plan. If you don't get this right, then you end up with a whole bunch of leakage, and you end up working way harder than your money is working. And the goal is that you want your money working at least as hard as you are, if not ideally harder than what you are. So that's what we want to avoid. And then the third element is about having expert support. So when you combine that with good systems, that's what allows you to maximize every opportunity. It's also what gives you the confidence when you combine it with a smart strategy. And so obviously we're a little bit biased in being in this space, but particularly if you're going into, entity structuring and complex tax planning, you want to make sure that you've got the right support in your corner so that you're getting the right results there as well. And so there's another layer to this, and there's a bit of an exercise for you guys here, because as we go around these outer rings, I'm going to talk you through the 9 different accelerators in each of these areas. And what I'd love you to do as we're going through is to rate how you're tracking in these. And it's just a simple traffic light: green, orange, or red. Green is if you're absolutely killing it. Red is if it's alert, there's a problem here. And orange is sort of like in the middle. And so I'll talk you through as we go through. The first one is around systems, and one of the key accelerators is having an optimization loop on your money. So you're getting feedback on how your investments are tracking. Is everything working to plan? Do you have a system that delivers you a feedback loop that allows you to make better decisions moving forward? Because every element of your money, it often doesn't work out exactly like it does in a spreadsheet. So you need that feedback loop to optimize your decisions. And so green here would be that you've got clear feedback, that it allows you to make awesome decisions. You know exactly how your money's working day to day. And a red would be, you're not really sure. It's really manual and clunky. If you're getting any feedback on how your money's tracking at all, not really sure if everything's working the way that you want it to. And the orange is sort of in the middle where it's like you're maybe getting a little bit of feedback, but again, it's probably sporadic and not consistent. I'd love for you to know. I see a bunch of people already just popping it into the chat. How are you tracking on this particular one? I'm actually going to color in my version on my side and sort of share the sort of the group average as we go through. We've got a few greens in there, but it's a lot of orange and quite a lot of reds in there as well. I'd say on average here we're in the red zone on that one, guys. The next one is smart risk, and so smart risk is everything with money has risk attached to it. Buying shares has risk attached to it. Using a trust has risk attached to it. Buying property has risk attached to it. Doing nothing has risk attached to it as well. And so with smart risk, you've figured out what the right risks are for you, and you've got as much of them as possible in your plan. That's probably a green rating in this one. And again, you can just pop it into the chat. If you're a red when it comes to smart risk is you're probably unclear on the different risks that are out there with your investments. Maybe, being a little bit fearful of risk has stopped you from investing in the past. And an orange would probably be like that you're doing some things, but you've got a bit of uncertainty and, you're not 100% sure, if you're really making the absolute most of the opportunity to be growing your money. Love to just see a bunch in the chat. We've got a few more greens in this one, so that's great. Probably makes sense given that a lot of people have come across from Sharesight. And on average, I'd say on that one we're going to be green. And then the next one that we've got here is minimizing your time input. So you want your money to work as much on autopilot as possible. You're working as the CFO on your money, that you're not having to spend your nights and weekends crunching numbers in spreadsheets or tracking down, admin or paperwork. A red here is that you're probably spending more time than you want on your money, or more time than you have available to you on your money, and that's really easy with a lot of people being time poor. And an orange is probably like you don't feel like you quite have enough the time that you want to spend on your money. You're doing some things, but it's sort of a little bit rushed. You sort of wish you could be doing more there as well. A few greens on this one as well, so that's good. Got a bunch of oranges, a few reds in there as well. The orange contingent is coming in a little bit late. I think on average we're probably orange on that one, guys. And so the smart strategy, the three elements that we've got here is the first one is around cutting your tax and making sure that you're minimizing that ATO donation as much as possible. That a green here would be that you're absolutely confident that you're not paying a single dollar more in tax than you need to. A red here would be you've got absolutely no tax plan and you're not sure. And an orange is like maybe you've done some things, but you know that there's probably more opportunity for you around this as well. This one is a tricky one, guys. And so we've seen quite a lot of red on this one, a few oranges as well there as well. I think on balance, this one definitely in the red. The next one is around protected leverage, and protected leverage is, using smart debt, using the bank's money to actually grow your money faster. Debt is a little bit scary and risk is really important to be managed, but particularly as you build up substantial amounts of wealth over time, using the bank's money at least a little bit can give you some real tax efficiencies and allow you to get ahead faster. And so a green here would be that you've got the absolute perfect amount of leverage, that's set up in a risk managed way, and your assets bubbling away nicely as a result of that. Red is probably that you've got no leverage, or sometimes it can be that you've got too much because maybe you've been a little bit reckless there as well. And an orange is that you're probably tracking okay. We've got a fair bit of red on this one as well. And look, the next element of smart strategies is around having secure investments. So basically that your investments are all giving you reliable, consistent progress over time, and that you're avoiding the chances of downsides and setbacks and those momentum killing mistakes. That would be a green. A red would be that you've got no investments, or you've got very, very few investments, or that their performance is inconsistent and they're sometimes good, sometimes it's not. I'm not really too sure on that one. And an orange is that you've got some investments, but they're tracking okay. Got a few more greens in this one, which is great as well. All right. So when it comes to support and I might just power through these ones quickly. I know you guys are keen to get to the trust content, and we're cracking into that in a sec. But I'm going to go through basically the first one is around having clear upside. And we're going to talk a bit more about this today, knowing that particularly when you're making decisions, and this is really important when it comes to trust, that you can see the upside and the benefit of doing that. You know what that is. You also the next one is having no agenda, and this can be particularly important when you're uh, you're dealing with trusts and you're looking to you might be getting advice from people and you will need to you can sometimes have conflicts that can hold you back. And then the third element is making sure that you're comprehensive as much as possible when you're getting support, so that you know that there are no gaps or issues that need to be there as well. I saw the question on recording. Yes, we are going to share out a recording off the back of this Sharesight. We're going to do that as well. All right. So, what I want to ask you just before we do crack in on the nuts and bolts around trusts is based on your colors. How well do you feel like you can fund your ideal lifestyle at the moment? You probably got, some green in there, a little bit of orange, a little bit of red, but overall, when you look at what you've done so far, how are you feeling about your ability to do what you want, at least today or into the future? You can give me the red, orange, green on this one as well. There's been a few orange, a few green, quite a bit of red as well. And look, I think I want you to walk away from here with some clear sort of action steps to take. And so I'd love to know, like, based on this, and you've got a notes page in the workbook. So just note down here, but based on all of this, what are the top three things that you know that you already need to change today? The top three changes that you need to make based on just what we've covered so far. And I'd love for you to write those down in your workbook, but I'd love for you to share maybe just the top one or maybe two if you're feeling generous. But based on what we've covered, what's squarely in focus for you right now? It's around reducing CGT. We've got another one around actually quite a few around superannuation, having a strategic plan, cutting tax, a lot of tax reduction as well. A lot actually. So I think that's definitely the winner. And cool, guys. So look, as we go through today, we're going to focus in basically there's three areas that we're going to cover off. We're going to talk about cutting your tax and specifically trust and trust strategies around that, smart risk and how you can use trust and trust borrowing to get ahead faster. And then we're going to talk a bit about upside and how you can figure out, whether a trust is right for you. But a big part of the reason why I've just spent a bit of time going through this model and how it works is I wanted to make sure that before we got into this, that you guys are aware that this is really a trust, and your tax minimization is just one part of a broader plan. If you want to really fund your ideal lifestyle, if you want to truly nail it with your money, there are other elements that you're going to need to get right. And obviously, in 60 minutes today, we don't have time to cover all of these different areas in detail. But you now have that model in place, and so you can see already where the focus areas are for you. And if you want to really nail it, you want to nail all nine. All right, so the first one, and I'm going to dive straight in. So we're going to talk about smart strategy. And as I touched on in that model, there are three elements to smart strategy. The first one is secure investments. I'm not going to talk about that in too much detail today, but I wanted to share this case study from a client of ours, James, that sort of shows this stuff in practice, because Sorry, just backtracking a little bit with your secure solutions. When you get this right, you basically get reliable, consistent progress. When you get it wrong, you have investment failures and setbacks, and you lose money. But more importantly, you lose time, or more expensively, you lose time. And so James came to us. He'd bought a property off the plan, and he got a bit of a windfall. The off the plan property didn't really work too well. Went through the process around planning. Ended up rent vesting to secure his investment capacity. He did that in order to preserve his ability to invest along the side using tax entities. So he had a bond and he had a trust as well. And basically, as a result of that, he was able to generate some strong five-figure tax savings from day one, but that would just compound and build over time. And he actually works in finance, and a lot of people were saying to him it would be a waste of time and money to actually go down this path. But the immediate benefits already sort of justified his investment of time and a bit of money in this as well. The next one is protected leverage. And when you get this one right, it's you're using the bank's money to get ahead. You can sleep like a baby at night, knowing that everything is super safe with your money. But if you get it wrong, you've either got no debt, meaning no progress, or you've got reckless debt and a whole heap of stress. And so again, we're not going to go too far into this today, but again, another sort of case study that talks about protected leverage. That basically, our clients, Luke and Talia, they came to us with a big focus on their home. They were sort of in a high income bracket, but essentially trapped on that income because they didn't really have any investments outside of their home. And so for us, we focused on replacing their salary and investing around that, doing some borrowing, but reducing risk around it. And basically, within 3 years, they'd added a ton in their investments. They almost didn't get started though, because they figured that they were sort of too late to the game, bit of that bury their head in the sand type piece as well. And so cut tax is sort of the key here. And this is where I want to get into trusts and particularly the how trust works, sort of the nuts and bolts of this. Just gonna some issue, slight issue with my slides here. Sorry, can someone just pop into the chat and just make sure that that's coming through okay? It's just this looks like a little bit glitchy at my end. Should just be the black screen. Cut your tax with a family trust and others. Perfect. Thank you, guys. And so, yeah, we're talking mostly about family trust, but know that there are other tax entities that can make sense based on your situation. We're going to talk about them a little bit more in the next section. And so, what we're talking about today is a discretionary trust or a family trust. Those terms can both be used interchangeably. That essentially, and this is a little bit of jargon, but just so you know, if you're thinking about going down this path, probably jargon that's important that you understand. A discretionary trust is, most family trusts are discretionary trusts. A discretionary trust simply means that you've got the discretion around how you manage the money and the income that's inside that trust. Typically, when people set up a discretionary trust, they do it for the benefit of their family members, and that's why it gets the name family trust. But a family trust is not actually a type of trust, just to be technical. When you set up a trust, the first thing is you do the legal sort of paperwork. Once you've done that, you get a tax file number and an ABN for the trust. Once you have those things, you can then open bank accounts, you can open a share investment account, you can even buy property and borrow to buy property, and you do that all under the trust wrapper, basically. The key rule with trust, so there's a couple of things here. The first one is that the income that's generated inside a trust from the trust investments is not included in your personal tax return. It's definitely not automatically included in your tax return. But the other thing is that basically all of the income from a trust needs to be distributed each year to what we call beneficiaries. If it's not distributed, it gets taxed at 47%, which is the top marginal tax rate, which sort of negates the benefits of having a trust in the first place. And so beneficiaries can be literally anyone, but most commonly it's family members, your partner, children, adult children, but it can also be parents, can be siblings, or whatever the case may be. When you distribute income from a trust to beneficiaries, the beneficiaries pay tax at their personal marginal tax rates. But what that allows you to do is to split income across multiple people. And I've got some examples to share with you around how that can obviously bring your amount of tax that you pay way down. The other thing that you can do with the trust, and we'll talk a bit more about this in the next section, but you can also set up your own investment company as a beneficiary of the trust. And the reason that you would potentially do that is that a company has a 30% tax rate that's attached to it, which is much, much lower than most people's marginal tax rates. If I look at particularly we did that exercise at the start, what the current tax rate is, then you're basically you're saving 10 to 17% by having income falling into a company rather than in a trust. And with an investment company, it works in this pretty similar way to a trust, in that you get a tax file number and an ABN, and once you've got that, you can then do exactly the same thing. So open bank accounts, open share accounts, buy property, etc. as well. And this is an investment company, also referred to as a bucket company. I did see some comments around bucket companies in the chat, but essentially this can be for a lot of people that are looking to build a serious amount of wealth. You have build most of your assets in the trust, but over time you end up building up assets in company as well, because typically you're already earning a decent income, you're already on a higher sort of tax rate, and you don't need the income, so it keeps it within this sort of group or net, I suppose. How it commonly works as well is that when you then get to the point where you're at the point of financial freedom, you want to retire or whatever, you can then pay yourself an income from your investment company if you want to. If that's built up substantial assets in there, you can pay an income from that. Or you can pay change over the distributions from your trust to be paid to you as your income as well. And so I'm going to go through a couple of examples. And I can see a bunch of questions. I will do my best to sort of keep up with questions, but there is a Q&A box. And so I'm going to have some time for questions at the end. If you've got a question and you want to make sure that it gets answered, please just pop that into the Q&A box, and I'll make sure I try and get to as many of those as I can. So a trust in practice, I've got a couple of different examples. So $100,000 of income that's getting generated through a trust. In this case, I just use a 40-year-old today with 100 grand of investment income. The tax on that in their personal name at the top marginal tax rate is $47,000 a year. If they have it through this trust and company type setup, the tax rate's 30% maximum, and so it's maximum of $30,000 a year. That means that you get a $17,000 annual tax saving. That's every single year, and that's essentially pure profit. Now, I did a little example here to show if you were to invest $17,000 a year for a 40-year-old today, by the time you got to age 65, you're looking at having, just based on the long-term share market return, 9.8%, you'd have about $1.8 million. So that's the power of a trust when it comes to saving tax, and then using those tax savings to further fund your wealth creation. Another one is if you've got 200 grand, you build up your assets so that you want 200 grand in retirement income. And funnily enough, that was sort of the average number that we spoke about for an ideal lifestyle level of income. If that's taxed at one person's marginal tax rate, then you're going to pay $60,000 a year in tax. If you split that across two people, it's immediately the tax is lower because you're using two sets of marginal tax rates, meaning that you'd only pay tax at $45,000 a year. That's a $15,000 annual tax saving in the future, meaning $15,000 more that you can spend on your retirement. And then the last example is around $1 million capital gain. So, for example, you buy a property in a trust, you got a $1 million capital gain on that property. You get a 50% discount on the capital gain, so it's $500,000. But if you've got one person there and that all goes into one person's tax rate, they're going to pay $206,000 in tax. If you can split that across two people, there's a 30 grand tax saving. The total tax is $176,000. You can split it across four people, like adult children, for example, and you and your partner, then you've got $83,000 tax saving. The tax is only $123,000. So again, the huge six-figure savings up for grabs here, and you can improve that even more with other smart structures around how you invest, because there's another level to this that if you look at, you've got assuming that you've got trust companies, and maybe you've got a super fund, maybe you've even got an investment bond, choosing the right assets to put in the trust versus the company versus the investment bond can make a really big difference. For example, with an investment bond, you don't pay any capital gains tax if you hold an investment for 10 years or more. Whereas in a company, you don't get access to the 50% capital gains tax discount. And so if you've got higher growth investments, they're generally going to be better served in, say, an investment bond or a trust. Whereas if you've got higher dividend paying shares, then having them in a company can give you the franking credits and give you a ton of benefits as you go through as well. And so the beauty of trust, or one of the benefits of a trust, is that you get the flexibility to change your strategy each year. You can distribute one year to yourself or split with yourself and your partner. The next year you can distribute to an investment company. A lot of flexibility in there as well. You have full control over the assets. You get a bunch of asset protection because all of your assets aren't just held in your name. That can be particularly important if you're like a business owner or you're working in a higher risk profession, like a lawyer, a doctor, or something like that. Also, these entities will often get separate borrowing capacities. I'm going to talk a bit more about this in the next section, but you can potentially look to recycle your borrowing capacity using entities. There's a bit of this in the spotlight at the moment. Some of it good, some of it not so good. But there is a benefit there as well. And the beauty with any of these sort of structures is that you can shut them down at any time if you're not getting the benefits out of it. There are some downsides though to using trust, that you've got to have a cost to set it up and to pay yearly for doing your tax return. A little bit of admin and management, rules to stay across, and there's land tax and CGT. And I'm going to talk a bit about this in the third section as well. But even with those downsides, and again, you've got to make sure anytime you're considering structures that the benefits are going to be worth more than the cost. But from just those examples, particularly if you're on a strong path, that easily 6 figures of tax savings there, and probably 7 figures when that money's invested and invested well. And so I'd love to know, from you guys, if you just pop into the chat on the 3 areas that we covered there around, cutting tax, protected leverage, secure solutions. What area do you think would make the biggest difference for you and your money? I think I know the answer to this one before they even start coming through, but yeah, no surprise there. We've got cut tax, tax reduction, cutting taxes, tax. There's a lot of tax there. The solutions around that, leverage as well. There's a couple of those ones in there too. And look, I suppose it makes sense given the topic that we're talking about, and hopefully after seeing that, you see how big the opportunity is there as well. And so the next bit I want to talk about is around systems. And so again, with the systems, keep in mind that we're really just focusing on one element of this, which is around your smart risk. But we also need to, there are other areas that you want to get right here. You want to get your optimization loop in place so that you've got feedback. That's really important when you're using entities so that you can make good decisions. You also want to minimize your time cost and the time input. There's quite a few greens in that as well. So it seems like you guys are doing well on that one already, but that's something that's super important as well. And then we get into the smart risk. And what I really want to talk about is borrowing and borrowing through structures here today. Now, when you get this wrong, you don't understand risk, you end up stressed, you end up with the wrong risks that erodes your confidence. When you get it right, you can understand that everything comes with risk, including doing nothing. You have the right risk in your plan, meaning that you maximize the amount of money that you make and you avoid the risk that's not right for you. And so I want to talk again, we're sort of just focusing in this one area, but specifically on borrowing through structures and how this works. And I just want to start with an example talking about the power of leverage. And what I've got here is essentially comparing 100 grand build up invested into shares and how that money would grow versus getting the $100,000, using it as a deposit. And in this example, I've got a $700,000 property being purchased. Now, I've used the long-term return for the share market, the long-term return for the Australian property market to give you a sense of how that money would grow. And basically what this says is that if you went down the shares path, after 1 year, you'd have about $110,000. If you went down the property path, your property would be worth about $750,000. The difference between those numbers, 640 grand. You've probably got a bit of debt there though, so we need to keep this in mind. This is obviously a super simple example. In the next 10 years, though, you see that the shares would grow to about $265,000, then the property grows to about 1.4 million. So the difference cranks up to like $1.1 million. And you keep that going 20 years and 30 years. The difference between shares and property, it's really sort of increasing. I think I clearly haven't done, I've got my maths the wrong way around on that one. But after 20 years, it's $2.1 million. After 30 years, it's $3.8 million of difference. And that's the power of property investing. And it's not because property is a super special investment. Property is the long-term return on property is actually lower than the long-term return on shares. But because when you buy property, you do it with leverage, that is a key driver of your results. And so I want to talk about how this works in practice. Now, this is a little bit complicated, so don't worry if it goes over your head. This is not the sort of thing that you're going to want to DIY anyway, but I wanted to talk through the power of it and how it works. Now, we've already spoken about trusts. And if you're using a trust to invest, that it ends up distributing money into an investment company to cap your tax, particularly if you're using this as a real wealth acceleration vehicle. When you do that, and in this example, and we're borrowing through an investment company. Now, in this example, and I've just used round numbers, it works whether I've used a $2 million property, a $2.5 million property with a $500,000 deposit. This works whether it's a $200,000 property. Not that you're really finding many of those, but $500,000, $1 million, $5 million doesn't really matter that much. Essentially, what happens, you buy the property, and when you first purchase it, because the loan is high and basically the mortgage is high and the rent is at the lowest point that it's ever going to be, the property will typically be negatively geared. Somewhere, and in this example, I've just used an amount of $50,000 per year. Now, what happens when you're borrowing through structures is that once you can build up the income of that structure to neutral, so you can cover that $50,000 shortfall from the property, you can then go again and basically do it again and again. So how you can actually cover that shortfall is by having other investments in the same company. And in this example, I've used building a share portfolio, build up the income on that. Then you basically got a pod, which is cash flow neutral, but you're getting a bunch of growth on it every single year. And then you can go again and reset your strategy and continue from there. Now, I'm not saying that you need tons and tons of debt or that you should be reckless with this stuff. Risk management is super important, but it is a pretty powerful way to use the bank's money to grow your money even faster. I saw some comments to say that you can do the same thing with share investing. Yes, you can to a degree, but there's a couple of important caveats there that when you borrow to invest in shares, you're typically paying a much higher interest rate. You're probably paying closer to 8, 9, or 10% on your interest rate compared to 5 or 6% on your mortgage. The other thing is that the banks typically will not lend as much. So with a property, they're typically going to lend 80%. With shares, they're not going to lend anywhere near that amount because of the extra risk in that. And so the assumption here is that over time, the mortgage goes down and the rental income increases. And so typically properties will end up getting less negatively geared over time. And so naturally, they almost close the gap themselves. It just takes a while to do that. If you want to close the gap faster and reload into the strategy, then you can use an investment company. You can use a share portfolio to build up that investment income faster as well. And you basically can rinse and repeat this again and again. Now, you want to make sure that you can obviously afford it and that you've got your buffers in place. And I'm going to talk a little bit about that as well. But when you do that, it's super, super powerful. And there's a ton of money to be made there when you get this strategy right. Now, when you're borrowing, and I just want to talk a bit about companies to dive a little bit deeper. There is that maximum 30% tax rate that I mentioned. That's one of the benefits. Anyone can set up a company. Basically, anyone. I put an asterisk here because the caveat is that as long as you're not on like some government blacklist somewhere, you're not banned or disqualified, you can. It costs between sort of $600 to $1,000 thereabouts. Don't quote me on that number, but it's going to cost at least $600-ish because there's a fee that you pay to ASIC for registering the company. And then it's like, depending on whether you're doing it yourself or getting someone to do you, then you need to do an annual tax return on top. But you see that for a few $1,000s here, you've got basically over 30 years, there's $3.8 million of benefit on a very, very basic borrowing strategy here of $700,000 of property, which you could seriously be, it could be a lot higher than that. So you typically, when you get this strategy right, you can definitely cover the cost, like, 10x, 100x easily. You can have multiple companies, as I mentioned. And look, one thing I would just call out here is that trust and company borrowing is squarely in focus. There has been a bit of spruiking around this stuff, and people talking about recklessly borrowing around this, and it does create a bit of extra risk. And so, it's likely that we're going to see more stuff coming around this as well. Now, I'm just a little bit mindful of time, and so I'm going to give you the super quick version around expert support. But the main thing that I want to talk about is really the upside and making sure you're getting clear upside when you're going down this path. Once again, know that this is just one part of this overall area that we need to get right. No agenda. You need, when you get that wrong, you've got people in your ear, they're creating more confusion and uncertainty, you're getting conflicted advice, you're wasting money on the wrong structures or losing out on money from not having the right ones. But when you have, when you get this right, you get clear advice that makes sense, confidence because you actually understand stuff, and you minimize your tax drags and maximize your money growth. I'm going to skip over Kate's story, but it is quite a good one. You want it to be comprehensive. You don't want to half bake this stuff or be cutting corners or do it because you listen to a podcast or even that you listen to an incredible webinar. Because when you get this right, you know that absolutely nothing is missed. You're not going to miss out on anything that's going to catch you out later. But if you get it wrong, it's uncertain, it's stressy, you end up not doing stuff, not taking action because you're worried something will catch you out. Again, I'm not going to jump into Sarah's story right now, just in the interest of time, but I do want to talk about the upside piece, because here it's like you can see the results that you're working towards, and it's literally just a matter of time until you get there. And when you get it wrong, you don't know, should you do a trust, or should you be doing something else, or is the plan on track, or whatever the case may be. And so I'll just give you through this sort of the key points as what you want to get. Skip over the stages model here, but essentially, when you're going down this path, the main thing that you want to be clear on is you want to be clear on the upside, to know that a trust or any tax structures or an investment company or some sort of combination makes sense. The only way that you can do that, though, is to be aware of the downside, the cost of doing that, making sure that you're understanding it. And I'll show you how this actually works in practice, that this is the process that you can use to set up a financial plan. It's the same process that basically anyone uses to set up a plan, but it's the same one that we do when we're doing financial planning for people as well. The first step is, and hopefully today has helped you get a little bit clear on this, is that you want to focus in on what's actually important to you. What are the opportunities? What are the issues? From there, when you're wanting to build a rock solid plan, you want to clarify all of the different moving parts of your money. What money's coming in, what's going out, what's left over, what assets have you got in place, what's the tax position, what tax strategies are in place, whatever. That gives you a baseline. Then from there, and particularly when it comes to trusts and entities, that you want to look at your strategy and go, okay, well, there are paths in front of you. One involves you building a share portfolio in your own name. One might involve building it through a trust or an investment bond. Another might be you introducing property into the strategies, using different entities, whatever the case may be. Each of them have different trajectories that are attached to them. And so the only way that you can really set up a robust plan is to know that you've got the right strategy, that you can see the upside, and that you've chosen the very best path for you. Now, when you do that, you're going to be clear on a strategy that gives you the right balance between getting ahead with your money, living the lifestyle that you want, making the progress that you want in the time frame that you want as well. Then you put it all into an action plan where you bullet point out the steps and automate as much as you possibly can. And then it's about that ongoing execution and refinement. When you do that, you can see the upside, you can manage the risk, you put your buffers in place, you don't have to compromise on your lifestyle, you get the confidence to take action, which is what allows you to take money. And it gives you also the systems to automate your success. And specifically when it comes to structures, it allows you to make the right moves at the right time. Because the right move at the wrong time is the wrong move. It also allows you to put specifically around the best assets to put in each of the structures, and allows you to use a tax save to further build your wealth. You got the right structure to keep across and support to manage and optimize things moving forward from here as well. Now, I'm going to show you I'll give you one final case study. I've names changed because I do get into a bit of the numbers around this, but basically these guys they're tech workers. They had RSU income, a bit of investment income. They were about to buy a $1.3 million investment property, and then they essentially would have capped out on their borrowing capacity. They were planning to start a family in about 3 years, and they knew that their income was going to crunch. And so they had this window and they wanted to make the most of it. After doing the planning process and going through it well, they ended up buying 2 investment properties at $1.4 million, one in New South Wales, one in Queensland. That allowed them to take advantage of the different land tax thresholds across the 2 different countries. States, countries, almost countries. And then they buffered their investment properties with 3 years of their cash flow shortfall, so they weren't going to be stressed when they started a family. Basically, just the land tax savings from this strategy with $21,000 a year. The property upside was about $100,000 a year on the properties that were there. And when they were going to get into the planning process, they almost didn't do it because they had an accountant which they really liked, they've been working with for a while, and he was saying that that advice was pointless because, and this happens a little bit with accountants, a lot of fantastic accountants out there, I should just say, and maybe yours is one of those, but we find that they sometimes get so fixated on tax that they can't see the bigger picture. And so huge upside from a few small tweaks, and luckily they did the planning, just in time to do that. So guys, I'm going to come to questions in a sec. I hope you've been got a little excited at the start there, and I sort of haven't been checking in too much throughout, but hope you guys have been taking down some action items and takeaways from each of those sections as you go through. What I would say to you is that you basically, by now, you already have the how, because that ideal lifestyle model, or the genius model as we call it, is your guide. It tells you what areas. Look at the things that are red first. They're going to be dragging you down. It doesn't matter how good your greens are. If your reds are there, they're going to be slowing you back. And that's basically the path forward. And so, we've been through a whole bunch of case studies today, but there's really only one case study that matters. And that's yours, right? You've got to find what works for you. And so I want you to use this ideal lifestyle model moving forward as your guide, in order to do that. And have a think about, for yourself from here, and you can do this, maybe write down some initial thoughts now, and you can complete this one afterwards. But what would a great result look like when it comes to your money in the next 12 months? Could be around trust, but it could be probably should be broader than that. And then think through, what are the things that you're going to prioritize in the next 90 days, the things that you're going to do it while everyone's taking their foot off the pedal in Christmas, and thinking that they'll just catch up in the new year, knowing that they're actually going to be starting behind, and then all of a sudden it's Australia Day, and then all of a sudden it's Easter, and still nothing has changed. What are you going to do in the next 90 days so that you're building momentum and moving forward? And I love this quote from Derek Sivers: "If information was the answer, we'd all be billionaires with perfect abs." I hope you guys have got some ideas from today. I hope you've got a bunch of ideas, but the power of any idea is only locked in when you take action, because that's when you make money. Now, I am going to jump into questions in a sec, but guys, also, this is the exact sort of stuff that we do at Pivot Wealth. And so, if you wanted some support around this, we basically got one intake left for 2025. You can essentially start the new year with all your actions locked in, so that you know that what you're doing, and you're going to knock it out of the park in 2026. As you might have already suspected by now, we focus on those 3 areas that we mentioned. Lost my slides. Smart strategy, solid systems, and expert support. And so basically how it works with your planning, everyone's got their own focus areas that are most important. We want to make sure we're covering all 9, but we want to dial into the ones which you do with your advisor, focusing on the things that are going to move the dial the most for you, give you the confidence to act quickly, and set up the systems to make things simple, so that you can essentially automate your success. Now, The next step for that, or the starting point for that, is we do these 45-minute money breakthrough sessions where we deep dive on some of the targets and the things that might be slowing you down or holding you back, as well as how you can plan. We charge $195 for those sessions, which we donate to charity. That's our business giving session, and you walk away with a bit more clear focus. My guarantee on this is that if you don't get value from that session, I'll personally cover the cost of it and chuck in $10 so you can buy yourself a plate of tacos. And so if you're keen on that, basically we do a quick screening call. So just as a bit of a fit check, I've just actually put the link into the chat, but there's a QR code on the screen. Basically a 10-minute call, talk through where things are at, give you a bit of Q&A if you need it, and help you understand the next steps and lock them in. So if you're keen to get around that, you can jump on that in the chat. And look, guys, I know that I've run a little bit over time, but I can see that there's a bunch of questions there. So I am just, for anyone that can stick around for a bit, I'm going to jump in and try and power through a few of these questions. Understand if some people need to go as well. George says, if time permits, please, keen to hear your thoughts on the Macquarie CBA changes with lending to trust. Yeah, that's a great one. Like it's an interesting area that basically, and for anyone that's not already across the background, Macquarie came out and they basically banned, or they've stopped lending to all trusts. CBA have also placed some restrictions on the trusts and basically not lending to new entities, and you need to be a customer of the bank for a certain amount of time to stop people from just setting up entities and doing stuff. And so I think that, what led to that was that Macquarie was specifically named, that there was, I don't know exactly who this was, but there was some influencer person that was specifically talking about Macquarie and saying how you could leverage the system for, them getting, borrowing multiple, buying tons and tons of investment properties, and they didn't like the public perception of that, and so they decided to knock it on the head. Pretty extreme case, but I think that it is more in focus, and I think we will probably see a little bit of tightening up. There are still going to be players, in my opinion, though, that are going to allow that stuff, and it's a super powerful strategy. I just purchased a property, did it in a company, and intend to follow that as well. And so there's always going to be ways that you can do it, but you want to sort of move if that's the case. What typically happens is that they're not going to unwind things in the future, and so you generally got a reasonable level of protection around that. I hope that's it. That makes sense. One from Lee says, how do you decide which assets sit in the bucket and which sit in the trust? That's another really good question. Typically, you want to look at the tax considerations and treatment for those different entities. And so what I mean by that is, like, with a company doesn't get the 50% CGT concessions. And so holding, if you've got cash and you're trying to choose, do you hold it in a trust or a company? Generally, it's going to be better typically, and this is not advice, but to hold that in a company, because there's no growth in the company, therefore no downside to not having the CGT discount. Whereas if you've got a high growth stock like a US stock or a startup, you probably want that in a trust, because if you get a good bit of growth, then you're going to be able to split out that growth to multiple taxpayers and take advantage of the 50% CGT discount. Hope that makes sense. It is a little bit complicated, and if you've got a decent amount of money behind you, that's where the real money is to be made. But you want to make sure that you're going to need some good advice. It's not something that you really want to DIY. Daryl says, as opposed to paying yourself a salary from your investment company, could you not loan the money to yourself tax-free? Look, I really love where your head's at with that one, but unfortunately not. The ATO have rules around that stuff. You can pay yourself a dividend out as an alternative. And typically, if there's tax paid, and I probably should have said this, if there's tax that's been paid on the income inside the company, then you're going to receive a tax credit for the tax that's been paid, meaning that the tax could already be paid at 30%. So if you can keep your marginal tax rate around 30%, you're not going to pay much more tax. Even if you pay up to the 39% tax bracket, the top-up tax will be pretty low. But yeah, if they have a rule that if you borrow from a related entity, then you need to pay it back, and the ATO wants their pound of flesh, basically. Guys, I'm loving all these questions. I am just a little bit mindful of time, but I'm going to just answer a couple more, and then feel free to sort of hit me up on socials if you got more. Raymond says, I was being biased by my accountant that I need to set up trust in a different state when I buy the when I buy the property in that state. Is that true? As acquiring an investment property in New South Wales, my accountant can't set up a trust in Victoria. Yeah, look, there are some complexities depending on the state. So that's probably a little bit outside of my area of expertise with that one. But your property conveyancer, your accountant will be the best guides based on that. If you're doing it, I think you generally set it up like my entities are in New South Wales and the property is in New South Wales. But I have heard that before from other trusts from other states. So I'm not too sure. All right. Last one. Angela says, can an investment bond be used to purchase shares or properties an alternative to an SMSF? Do in-specie transfers reduced in excess of the $3 million government extra taxes coming in? So you can have shares in an investment bond, if that's the question. With an investment bond, it's like a lot of other investment accounts. You can have shares, you can have ETFs, you can have managed funds. You generally can't have property, or at least not yet. I think that we may see some innovation in this space in the future as well, but not at this point in time. In terms of in-specie transfer, I think if you transfer money out of your SMSF, then that will reduce you for the balance cap around that as well. So I think you could. I hope that's what you mean. Well, look, guys, I once again I appreciate all the questions. I hope you found that helpful. We've got a bunch of these sessions. This is actually our last one for the year. So well done for everyone for jumping in. Got a heap planned for next year. Check out if you want to touch base, jump into one of those chats. And happy to talk more if we can help. Otherwise, in the meantime, guys, happy investing.